As long-term subscribers will know, back in 2014, GE spun off a company called Synchrony Financial. The very odd subscriber will know that you had purchased it. Could you maybe speak to that a little bit, going back a ways?
Sure. Yeah, it is funny how sometimes we do get an odd question about Synchrony. You're right, I do own it. Way back in 2014, I opted to convert most of my GE stock into Synchrony. And since that time, I've actually added to the position a few times, the latest time being in March 2020 when the world was just falling apart everywhere. And I picked up some shares at $19 and change. I should say, though, that Benj didn't convert any of his stock into shares. He kept all his GE position, and he still owns it for that matter.
And what do they do specifically?
Right. Synchrony, what they do is they are a credit card company, and their closest peers are MasterCard, Visa, Capital One, companies like that. But unlike most credit card companies, Synchrony is largely a private label or a co-branding credit card. In co-branding, what that means is they will establish a relationship with, say, Gap or Lowe's or JCPenney, and then issue a Gap-specific or a Lowe's-specific credit card to their particular customer base. And this means that it's something of a hybrid credit card, if you will. They have store-specific opportunities and exclusivity for their customers, but then they also have the typical features of a credit card like rewards or cashback or whatever you have.
Oh, interesting. Okay. Well, it sounds like it's a bit of a niche within the financial sphere, or maybe even a niche within the credit card sphere, really.
Yeah, it is certainly a niche, but it's still quite competitive. In 2018, for example, Capital One poached Walmart right from under Synchrony's nose, which, depending on which analyst you talk to, that really hurt, and it was a big loss for the company.
So, sorry, just going back. So, why did you choose to convert some shares to Synchrony, and do you still like it? I mean,
Right, that's a good question. So, I would say I've just said how the credit card business is competitive, but it's not as competitive as GE's other lines of business. GE's in many, many, many divisions around the world, and their landscape on almost every front is very competitive. And the balance sheet looked better than GE's. The terms of the conversion were good, which was a big factor. Valuations looked fine. And then I thought that the cash flow generation of a credit card like company would be much better than the cash flow generation of an industrial like GE. And so far, those dynamics have played out. I wouldn't be a buyer of Synchrony at these levels or these days, but they have a very strong franchise and the cash flows have been very good and supported decent dividend and buyback. And they can fund growth internally too, which is quite an enviable position to be in.
sure. So, I guess if we had to say buy, sell, or hold, it kind of sounds like you might be in the hold range.
Yeah, I would say it's in the hold range. If it were under $25, I would look at loading up more. If it were over 60, I'd probably look at lightening up. And that's how I think about it right now.
Okay, great. Well, thanks for those thoughts on Symphony.